Good morning. Saturday, April 25th, 2020. Thanks for watching. I wanted to cover a couple different things. One is for those of you that are in what they call qualified plans, which is 401ks, IRAs. I would want to introduce you to a software program that you can learn about through YouTube. They've created some videos, and there is one that's titled Qualified Plans. So you can either talk to your remote or you can type it in. But the name of the company is Truth Concepts. And then if you also typed in Qualified Plans, or you search for that video, very, very interesting, because most people think in terms of 401ks as well. I want to put at least as much as I can get a match on. So if they say up to the first 6%, they'll match 50 cents on the dollar. We kind of look at that as free money. But as you'll excuse me if you'll watch that video, and of course I think it was created 4 or 5 years ago, so some of the numbers that are in there, and interest rates and that kind of thing might be more relevant to that time, but it's all the same. You can plug the numbers in and you'll see that you actually lose a lot of that match through something just as simple as fees, because there's fees involved, the asset management of those mutual funds and so forth that are inside these qualified plans, typically 401ks anyways. What happens is they're charging a fee. There's also some fees in the trading of the stocks within those mutual funds. And even really conservatively, because people talk about they could be anywhere from 2 to 4%, and you'll see in the video, if you look it up, that they use something really conservative on the low end. I think 2% was what they used, and you will wipe out all of that, because what you're being charged is fees over time. It's not like fees 30 years down the road. That they just take off the 2%. No, they're taking 2% off the table all the time throughout the amount of years that you're building up or trying to build up a retirement nest egg. Remember, like what I said in previous videos, that all that stuff is at risk in a qualified plan if it's in the market. And that is what you consider your retirement savings, and it's really your retirement investing, which means your retirement speculation, which means you could lose it all, or you could lose big chunks of it, or the timing of when you're in and out of the market, or the amount of money that's sitting there during that loss, and how long it takes for to get the money back. I'll use a quick example of what Wall Street does. They talk in terms of average returns, and the word average is really key here, because if we'll take a really simple example. You may not have heard of this, but if you were to get a 50% return on $100,000, you'd have $150,000. I'm saying a positive return. If you had a negative return the next year, you would not be back to 100,000. You'd be at 75,000. But if you take those 2 years and their averages, so 50% up and a 50% down, you'd have an average of 0%. But the truth is that the real rate of return was a negative 12.5%, thereabouts. And so that's the trickiness of it all. Averages is not really what you're looking for. You're looking for the real rate of return over the long term, if that's where you're going to be for the long term. So with that, I want to jump to something that some of you may have heard of, may have not have heard of, but it's called life settlements. And life settlements are when somebody has a life insurance policy and they have a surrender value to it that may be, for example, $250,000. That means there was cash in there that if they canceled the policy, they could get all $250,000. Now they might have a death benefit of $3 million, for example, on that same policy, but they don't really care about the death benefit anymore, so they want to settle with somebody. And there are firms, mostly law firms, that work these transactions and settle with a person on their life insurance, and they may give them 2, 3, 4 times as much as what the cash value is. And so on that example with 250, like if they may get $1 million, right? Now there's companies that buy those settlements from the law firms and they put them into like a fund. So there's multiple policies that are in this situation, and some of these funds, what they do is they typically buy policies from somebody who's late in life, so to speak, late 80s, 90, and they know actuarially how this is all going to play out. They know that if you're 90, you're likely to die in the next 6 years or so. And so what they do is they do pay that premium on the cash reserve. So they may give the person $1 million. Now they're buying it from somebody else, and they put all of these policies into a fund, and they pay the premiums. But knowing that some of the people are going to die in a couple of years, some are going to die in 8 years. All in all, they know they're going to make out, that it's going to work out, and it's a really solid investment. The one thing is that typically you have to have money that you want to set aside for roughly 10 years, but also they are projecting, and they conservatively project and perform at 10 to 12% annually over that time period. So it's a really rock solid investment, and it's something that I'd be happy to share with you, get you some more information. I can say for the most part you have to be what they call an accredited investor. An accredited investor is someone who's making $1 million a year, or I believe as an individual, the last 2 years you've been making at least $200,000 a year, or your household is at $300,000 a year. There may be some flexibility in that, and in fact there is, but we have to walk through a couple bits of information, make sure you understand it, and you can step outside of being an accredited investor. Typically, the minimum investment is $100,000, but a lot of people are looking for ways to maybe get out of the stock market but still get good rates of return. And I'll tell you, I don't think, not that I'm giving, financial investment advice, but it's because these things are going to have to pay out. These life insurance policies are going to have to pay out. So these funds, when the person dies, they collect the death benefit. And so they may have paid $1 million for it, but they're going to get paid $4 million. You can quickly see that if you had, 50 to 100 of these policies inside of a fund, that it's going to play out really, really well for your investment. And again, if you have some questions on that, I can refer you to a life settlement fund. But let's have a conversation, and then we'll go from there. I can send you some data for you to look over, and then I could, connect you with the co-founder of the company, and it might be something that you want to consider as an option. And I hope you have a great Saturday, and until we talk again, take care. Bye.